Sir, third quarter earnings for the bank, quite happy for you guys, up 29% year on year, and that brings your 9 month earnings up 35% year on year. But what's more exciting here is that the quarter on quarter growth, at least the quarter on quarter performance, has seen growth since the start of pandemic. You've said that this is the only bank to sustain your growth even throughout this difficult period. What is underpinning this?
Well, really, we've been very much more focused on the metrics, no? And going into the pandemic, we're really we're really heavier on corporate lending, and we have made more strides, to make fixed rate loans. So we don't have too many of those floating rate loans, which would drop immediately. So these fixed rate loans have cushioned us and has helped improve our net interest income. Of course, let's not forget that the BSP has been very proactive in pushing interest rates down. So we and the entire banking industry have also benefited a lot from lower interest rates. So that has given us and everyone else a decent cushion. No? So now I think that we are coming out of this um, this pandemic weakness, and business is normalizing a little bit more. We've seen our fee income improve. The fees, the commissions, these numbers have gone up a little bit more quarter on quarter. So we're very happy about that. We're very focused on keeping costs low, and it's not that we are not spending, but we are spending smart, and we are really putting more um, investments now into our digital platform.
Okay, sir, we'll get back to your digital platform in just a bit, but you did mention that your bank benefited from the low interest rate environment. Would this be sustainable moving forward, specifically with higher inflation looming here, and even the rest of the world also possibly paring back stimulus, let's say over in the U.S., and we might be keeping in step with that. Are you worried that this might affect your margins in the future?
Well, margins have pretty much peaked right now. No, I think going into the pandemic, our net interest margin, which is the difference between what we earn on loans and investments and what we pay on the interest expense, that net interest margin was around 3%, maybe slightly below 3%. We are now above 4. To be exact, we're at 4.2. I think margins have pretty much peaked right now because interest rates have been kept quite low, and the loan rates are coming down a little bit now. As I said earlier, we have a lot of fixed rate loans, but as these loans reprice, the stronger borrowers are able to refinance at a lower rate. So there is pressure on margins, not just on China Bank, but I believe for the rest of the industry.
Are you seeing a market improvement in the loan growth story?
We've seen some loan growth coming back. On the side of China Bank, we are really more focused on the real estate sector. We don't have so much of the unsecured lending, but we believe that as we move out of this pandemic, really the consumer should be able to bounce back. No, so banks with exposure to consumers should be able to get a pickup later on.
So let's talk about provisions. You mentioned that 6.5 billion were set aside, relatively flat versus last year. Is that enough to cover the potential NPL losses, not just this year, but also moving forward if there's a lag in that? And do you see an improvement in the NPL ratios? You mentioned that you're looking mainly at secured lending.
Yes, NPL ratios, we have made adequate coverage. We believe we've made adequate coverage, unless something very bad happens. And, a number of banks had lowered provisions this year. We have kept ours quite steady. So we think we are adequately provisioned. The loan book is not as bad. It has been holding up. As I said, we have been lending to corporates, and some of these corporates and conglomerates are the stronger ones financially. So we've been able to hold it, and hopefully, as the recovery picks up, as the economy picks up, then the profits of these companies will bounce back.